For a very long time, America had these things called savings and loan associations, or S&Ls for short. Think of them as the banking world's boring but reliable uncle. Their job was incredibly simple, almost beautifully so. People in a community would put their savings into the local S&L. The S&L would then take that money and lend it out to other people in the same community, specifically so they could buy houses. That's it. That was their whole deal. They were not trying to invent the next cryptocurrency or finance a hostile takeover of a rival cupcake factory. They were just in the business of turning your savings into your neighbor's mortgage. It was a simple, stable 363 model. Pay 3% interest on savings, charge 6% on loans, and be on the golf course by 3 p.m. This system worked remarkably well for decades, mainly because it was designed to be as exciting as watching paint dry. S&Ls were heavily regulated, which sounds bad, but in this case, it was like putting bumpers on a bowling lane for a toddler. The rules kept them from doing anything too stupid. They were basically restricted to taking in deposits and making long-term, fixed-rate home loans. This made them pillars of their communities. They were the financial engine that powered the American dream of homeownership, one white picket fence at a time. The local S&L chairman was probably a guy you saw at the grocery store, not some Wall Street titan in a helicopter. It was a cozy, predictable, and frankly, very untelevisual arrangement. The entire business model was built on a simple, predictable truth. The interest they earned from mortgages would always be a little bit higher than the interest they had to pay out to savers. This steady, modest profit margin kept the lights on and allowed them to slowly grow. It was a financial ecosystem in perfect, if somewhat dull, harmony. Savers got a safe place to park their money and earn a little interest. Borrowers got access to the capital they needed to buy a home and start a family. And the S&L itself just chugged along, facilitating the whole process without much fuss or drama. It was the financial equivalent of a sensible station wagon. Not flashy, but it got the job done reliably. But here is the crucial weakness in that sensible station wagon. Its engine was designed for one specific type of road. The loans they made were almost all long-term mortgages with fixed interest rates. This means if they gave someone a 30-year loan at 5% interest, that's the rate they were stuck with for 3 decades. This was fine as long as the interest rates they had to pay to their depositors stayed low. But what if those rates suddenly went up? What happens when the cost of your fuel suddenly becomes more expensive than what you can sell it for? Well, as we are about to see, the answer is a spectacular, slow-motion car crash that everyone should have seen coming. Then came the late 1970s and early 1980s. A period of wild economic turmoil. The country was hit by something called stagflation, which is a fancy word for when the economy is stagnant but prices are rising anyway. It's like being stuck in traffic while your car is also on fire. To fight this soaring inflation, the Federal Reserve jacked up interest rates to historically high levels. Suddenly, people could get a much better return on their money from new things like money market funds than they could from their sleepy old S&L paying a measly 3%. Savers began pulling their money out of S&Ls in droves, which is a big problem when your entire business is based on, having people's savings. The government, in its infinite wisdom, decided to help. Congress passed new laws, most notably the Depository Institutions Deregulation and Monetary Control Act of 1980 and the Garn-St. Germain Depository Institutions Act of 1982. These laws were supposed to let S&Ls compete in the new high-interest world. In reality, it was like telling your mild-mannered uncle who only ever drove a minivan that he was now free to enter the Monaco Grand Prix. The new rules allowed S&Ls to offer higher, more competitive interest rates to attract depositors. But more importantly, it let them invest in a whole range of new, much riskier things beyond simple home loans. Suddenly, these small-town bankers, whose biggest decision of the day used to be whether to approve a mortgage for the local dentist, could now Media Group, banker approving mortgage, commercial real estate, speculative investments, stock distribute and got equally, speculate on commercial real estate, invest in junk bonds, and make risky business loans. It was a classic case of giving someone a lot of rope and then being surprised when they immediately hang themselves with it. These S&L managers had no experience whatsoever in managing these kinds of high-risk, high-reward ventures. They were experts in 30-year mortgages, not in complex financial derivatives or speculative land deals in the middle of the desert. It was a recipe for absolute, unmitigated disaster. To make matters even worse, the government made another brilliant move. They increased the amount of federal deposit insurance from $40,000 to $100,000 per account. This meant that even if an S&L made incredibly stupid and reckless bets with your money, the government guaranteed you would get it back, up to $100,000. This created something called moral hazard, which is a polite way of saying it encouraged bad behavior. For S&L owners, it was a casino where they could bet with someone else's money. If their risky bets paid off, they kept the profits. If the bets failed, the taxpayers would cover the losses. It was a no-lose proposition for the people running the show, and a heads-you-win, tails-I-lose situation for the American public. With the regulations gone and a government backstop in place, many S&Ls went completely off the rails. They were stuck with a portfolio full of old, low-interest mortgages that were losing them money every single day. To cover these losses and chase huge profits, they dove headfirst into the riskiest investments they could find. Instead of funding a family's dream home, they were now funding Media Group, 1980s office tower construction site, half-finished abandoned office buildings, city skyline with empty office towers, stock, distribute equally, speculative office towers in overbuilt cities, sprawling shopping malls in the middle of nowhere, and even in some cases, financing corporate takeovers with high-risk junk bonds. The once boring S&L had transformed into a high-stakes gambler, desperately trying to hit a jackpot to stay alive. This high-risk strategy was a ticking time bomb, and it wasn't long before it exploded. Many of the commercial real estate projects they funded were poorly conceived and failed spectacularly, leaving the S&Ls with massive losses. The junk bond market, another favorite playground for these newly liberated bankers, also proved to be a minefield. As these risky bets went sour one after another, the financial holes in these institutions grew deeper and deeper. The problem was that these bankers were not seasoned investors. They were just guys who had been handed a rule book with all the rules crossed out and told to have fun. And the fun, it turned out, was incredibly expensive. Faced with mounting losses, some S&L executives didn't just get reckless, they became outright criminals. A culture of fraud and corruption took hold in the most troubled institutions. There were cases of executives using company funds to buy themselves. Media Group, luxury private jet on tarmac, businessman boarding private jet, executive yacht docked in Marina Estaca distribute equally. Private jets, yachts, and lavish art collections. They made loans to friends and cronies with no expectation of ever being paid back. In some of the most infamous cases, like that of Charles Keating and his Lincoln Savings and Loan, they engaged in elaborate accounting tricks to hide their massive losses and make their failing institutions look profitable. They were essentially lying to regulators and the public, hoping to keep the party going long enough to figure out an escape plan. By the late 1980s, the entire industry was collapsing under the weight of its own bad decisions and fraudulent activities. Hundreds of S&Ls across the country were insolvent, meaning their liabilities were far greater than their assets. They were zombies, kept technically alive only by accounting gimmicks and the hope of a miracle. The simple, stable business of community home lending had been replaced by a nationwide bonfire of greed, incompetence, and outright criminality. The party was officially over, and soon, the bill would come due. The only question left was who was going to be forced to pay it. When hundreds of these financial institutions failed all at once, the Federal Deposit Insurance Fund, the FSLIC, was quickly overwhelmed. It simply did not have enough money to pay back all the depositors of the failed S&Ls. The government was faced with a catastrophic crisis. The failure to honor deposit insurance would have shattered public confidence in the entire U.S. banking system, potentially triggering a much wider economic meltdown. So the government had to step in and do what governments do when faced with a mess of this magnitude. It threw an enormous amount of money at the problem. And whose money was it? Oh, you know, it was yours. In 1989, President George H.W. Bush signed the Financial Institutions Reform, Recovery and Enforcement Act, or FURIA. This was the official cleanup operation. The law created a new government agency called the Resolution Trust Corporation, or RTC. The RTC's job was essentially to be the world's largest repo man. It took control of hundreds of failed S&Ls, seized their assets, which included everything from half-empty office buildings and golf courses to a staggering collection of bad loans, and tried to sell them off to recover whatever money it could. It was a massive, messy, and incredibly expensive undertaking. The final bill for this fiasco was staggering. The S&L crisis ended up costing American taxpayers an estimated $124 billion. And that's in 1990s money, which, adjusted for inflation, is a truly eye-watering sum today. Over 1,000 S&Ls ultimately failed, wiping out a huge chunk of the financial industry. The RTC spent years liquidating assets, and federal prosecutors went after the worst offenders, with over 1,000 S&L executives being convicted of crimes. Charles Keating, the poster boy for the crisis, was sent to prison. But while some individuals were punished, the systemic failures that allowed the crisis to happen were the real story. The primary lesson from the S&L crisis is a simple and timeless one. Deregulation without adequate supervision is a recipe for disaster. Allowing financial institutions to take on huge risks while protecting them from the consequences with taxpayer-funded insurance is fundamentally a terrible idea. It creates a system that privatizes profits and socializes losses. The crisis led to stricter regulations and a renewed focus on government oversight of the banking sector. Of course, as the 2008 financial crisis showed us, it seems to be a lesson that we as a country have to learn over and over and over again. Because if there's one thing more reliable than a boring bank, it's our collective ability to forget why they were boring in the first place.